Hello and welcome to Star USA Training. Today is Tuesday, August 8th, and we'll be talking about the importance of trade compliance during mergers and acquisitions. We are recording this webinar. The slides and the recording and any other materials will be made available after the broadcast. One NCBFAA credit is available, and the code will be provided in the email that goes out that includes the recording and materials. All participants are going to be muted, but the Q&A feature on the webinar software is available. If you have questions, we strongly encourage it. I will answer questions throughout and take more at the end as well. Today, we're going to be talking about trade compliance in mergers and acquisitions, looking at the concept of successor liability, some of the strategies, practices that we can use in order to navigate through mergers and acquisitions from a trade compliance perspective. But before we jump into that, let me do some introductions into who Star USA is and who I am. Star USA is a consulting, advice, training, and services firm in the field of international trade and compliance. We're based out of Northeast Ohio for the last 25 years, and we provide an array of services to importers, exporters, brokers, carriers, forwarders of many different sizes and skill levels. We specialize in we're just really good at taking a problem, figuring out a plan of action, and then moving things forward. That's really where our strength lies. We were founded on the premise that knowledge is power, and we believe that sharing our experiences can help you improve and strengthen yourselves as individuals while providing value to your organizations. We are CTPAT certified as a U.S. Customs broker, and we take pride in finding the right balance of service and compliance for our clients. I am not a lawyer, and what we are providing today is not legal advice, but we do provide all kinds of advice in these areas. If you are interested in learning more, please feel free to contact us at the email address or by checking out our website below. But we tackle a lot of things. Me personally, my name is Mike Easton, and I am the president and general manager of Star USA. I have my customs broker's license, and I've been in the international trade compliance industry for nearly 20 years. During that time, I've worked with clients of all shapes and sizes, all different industries, and I thoroughly enjoy the work that I get to do because I always learn something new and interesting, and I'm hoping that you learn something new and interesting from today's session, and I look forward to your questions and feedback. So when we talk about mergers and acquisitions, I want to narrow the scope of the universe. When we're talking about trade compliance, it can be pretty broad, and today I'm only talking about U.S. imports and exports. I recognize that mergers and acquisitions on a global scale involve many other government agencies, many other countries and regulatory bodies, and a lot of different issues can arise during mergers and acquisitions, but I can't cover them all because I'm not expert in them all. If I were, I would probably try to cover them all. But I find it helpful to understand what your liability zone looks like. Which agencies are you reporting to or are going to hold you responsible? And what are some of the risks involved in the mergers and acquisitions from a trade compliance perspective? We will look at some of the specific methods and expressions, but they are going to vary based on regional laws and customs and practices. So up top, we've got the U.S. import agencies. The primary one that we are concerned with is U.S. Customs and Border Protection, CBP. They are part of the Department of Homeland Security, and they are responsible for all border enforcement. That includes imports and exports. CBP will seize your goods on the inbound side and on the outbound side. On the outbound side, it will be at the behest of another agency, but CBP is involved on both directions. But they are the primary U.S. import agency of concern, but they work with more than 20 other agencies that have an interest in goods, commodities, products coming into the United States. Those are referred to collectively as partner government agencies, PGAs. And there are more than 20 of them. They include things like the Animal and Plant Health Inspection Service, which is on a tear right now, flagging import cargo for invasive species, pests, and plants that hijack or will stow away into a container and make their way to the U.S. and cause havoc on the environment. Additionally, the EPA, FDA, FCC, NHTSA, all of these agencies have an interest in certain types of cargo coming into the U.S. CBP puts out a PGA import guide that if you are in one of these areas where these other agencies are impacting either your imports or the imports of the company that you are merging with or acquiring, I definitely recommend getting an understanding of what those PGA requirements are. Those are not going to be in the scope of today's session. That's too much to cover. But if you need some help navigating, you can ping us and we would be happy to show you. I think I mentioned it later as well, But through the automated commercial environment, through ACE, you can download a list of which PGAs have an interest in which products by HS classification, which is a very useful tool for identifying if you're going to have any PGA-related questions that you need to address. So yeah, our import agency is primarily U.S. Customs and Border Protection, and then the other agencies work with them. On the export side, we've got two different categories of exports that we're concerned with. We have export compliance, which is the U.S. Department of Commerce Bureau of Census. These are the foreign trade regulations, the FTR, and these have to do with the EEI filings and the information that's filed prior to an export occurring. And then more intense than compliance are the export controls. And that starts with the Bureau of Industry and Security, the BIS, also part of the Department of Commerce. They are the administrators of the Export Administration Regulations, the EAR. Got the foreign trade regulations and the EAR that are both under Commerce. And then we move into the International Traffic in Arms Administration, ITAR, which is governed by the Directorate of Defense Trade Controls, the DDTC. This has to do with the United States munitions list and military and defense services and products. And then lastly, in the controls category, the other agency that has a lot of attention paid to exports as they leave the US is the Office of Foreign Assets Control, OFAC. They are controlled primarily with the movement of money. They are under the Department of Treasury, and they administer the sanctions and embargoes programs on various countries. There are many other agencies that are involved in U.S. exports. I'm not listing them here, but you can refer to supplement number 3 to Title 15, Part 730 for those other agencies. And you can use the links when you get these slides to navigate to those things if you are interested. So those are our primary agencies of interest. We have the U.S. Import, Customs and Border Protection, and then the exports. We've got Census, BIS, DDTC, and OFAC, all of which have different penalties associated with violations, and all of which have an interest in transactions that occur prior to an M&A, but might not be uncovered and not be settled until after a merger or acquisition has taken place. And one case that we have here is an example of successor liability. This is the case in brief that we're looking at here, but export violations occurring in 2005 resulted in penalties in 2014 against the successor company. In this case, Western Advanced Engineering Company, called Waco, exported a controlled machine without a license in 2005. They were acquired by C.A. Litzler Company in 2011. And in 2013, C.A. Litzler was added to the BIS case against Waco and was found jointly and severally liable for the 2005 violation. And as a result, in 2014, C.A. Litzler paid $45,000 civil penalty, and Waco additionally agreed to a 3-year suspended denial order. You read about that case, but it's one of the clear examples of successor liability, and the fact that a violation occurred prior to a merger and acquisition, in this case, almost 10 years prior to the settlement, does not excuse or absolve that violation, and the successor company can inherit that liability. And that concept is called successor liability. Under the practice of successor liability, businesses can be held liable for violations committed by companies that they acquire. BIS provides some guidance on what you can do in order to mitigate or at least recognize what sort of liabilities you'll inherit as a successor in a merger or acquisition scenario. For example, they say have a structured due diligence review and determine whether the acquired company has violated any laws, examine trade histories, compliance practices, commodity classifications, exchange of technologies, any licenses and authorizations that may be in place or may have needed to be in place, as well as foreign employees with access to controlled technologies. And this is one of the areas where a lot of companies struggle in not recognizing that in an M&A scenario, if you're being acquired by a company that's foreign owned, that could create issues if there are personnel, foreign nationals working on the production of the materials in various parts of it and have access to certain controlled technologies. That could be a violation. And if you haven't addressed those sorts of controls, you could have some liabilities that you were not expecting. Any disclosures should be submitted that outline any violations that are uncovered, if not by the company responsible, then by the company seeking to acquire it. You can read a little bit more on that in BIS's Don't Let This Happen to You publication. There are some guidance in there, as well as other cases and histories of companies violating the regulations, in particular the export regulations, and what the outcomes of those events were. But you'll see here that BIS is recommending disclosures be filed when any violations are uncovered. And the concept of disclosures, we actually addressed these in a webinar a couple months back, which you can go back and view on our website at that link there. But there are two types of disclosures that you can use to reduce your risk footprint or your penalty footprint, or at least count as a mitigating factor. On the import side, we have what's called prior disclosures. Prior disclosure, which is defined under 19 CFR 162.74, allows for disclosures of violations of 19 USC 1592 or 1593A made without knowledge of a commencement of formal investigation of that violation. Basically, if as an importer, an import violation has occurred and you disclose it under the prior disclosure rules, then you can avoid all penalties. It will protect you from the assessment or establishment of penalties by customs. They will not be able to levy a penalty against you. You'll still have to pay back any duties that were owed, as well as any fees and interest on those amounts, but you will not be subject to a penalty for that violation. And that's a very important degree of protection, and it highly incentivizes importers to inform customs when they make a mistake and take steps to correct those mistakes voluntarily. That's your prior disclosure on the import side. You get that full protection from penalties. On the export side, you have what's called voluntary self-disclosure, and those rules can be found under 15 CFR 764.5, which include the disclosure of circumstances of a violation of the EAR or the FTR made to the Office of Export Enforcement, the OEE, prior to the U.S. government learning of the same from another source or prior to them commencing an investigation or inquiry in connection with that information. So one of the key differences here is that an export voluntary self-disclosure requires that the government not already be aware of that violation, whereas a prior disclosure on the import side means only requires that you not be aware that customs has opened an investigation. Basically, they have not told you that we are investigating you. That's on the import side. On the export side, if customs or if BIS or census or one of the other agencies is aware of a violation already, regardless of whether you know they're aware, then you may not get the protections of the voluntary self-disclosure. And additionally, in a VSD scenario, in a voluntary self-disclosure scenario, the protection you get is it counts as a mitigating factor, but does not prevent the imposition of penalties. So any violation that occurs, particularly violations of the export control regulations, EAR, DDTC, ITAR, OFAC, things like that. If you violate export controls, you're likely to be subject to a penalty to some degree, but it will be potentially mitigated depending on your voluntary self-disclosure. So these are ways that you can protect yourself, or at least minimize the risk footprint as you go through an M&A scenario, being aware that these vectors exist that will help you navigate through the agencies and come out the other end with as small of a problem as you can manage. It is not at all uncommon for errors or violations to be uncovered during M&A due diligence checks and in evaluations. Sometimes they don't show up until months after the fact, and that's usually a product of not having a proper foreknowledge and awareness of the M&A itself, of the practices of the other organization, and those things kind of shaking out through time. But it's important to recognize that you do have a way to mitigate those risks and who you're working with and where to find those regulations. So we're going to talk a little bit about the focus strategy. We've looked at the liability zone and what universe we're operating within when we talk about trade compliance and what agencies we're dealing with. And now we're going to talk about how we actually go about navigating through M&A from the perspective of trade compliance. And I've done this several times, and I've learned a lot of lessons along the way, but I tend to boil it down to needing to balance two competing / in tandem objectives. The first one is the ongoing operations. Basically, what is going on with regard to actual shipments, international transactions, both before, during, and after a transition, an M&A scenario. And I balance that against the compliance risks across a myriad risk zones, which we'll take a look at, that may be uncovered while those operations are ongoing. And in my experience, the trade compliance teams that are tasked with navigating these areas need to understand these competing objectives, but also how these competing objectives work together in helping inform the bigger picture. I advise most companies to first establish what their priorities are during an M&A scenario. So generally, the business is going to want to prioritize existing business operations and minimizing a lapse in service. That's how the business makes money. That's the whole point of doing an M&A, acquiring a new company, of merging. The whole point is to expand and grow your business, grow revenue, and any interruption to that business is seen as a bad thing. It makes sense, but also it kind of competes directly with evaluating those compliance risks. However, I would say that those risks, and recognizing where those risks lie and where you could be inheriting or perpetuating regulatory violations, is in service of sustaining those ongoing operations. In my experience, prioritizing your business operations works hand in hand with recognizing and identifying your risks. As you unpack what the operating environment needs to be, you are also investigating other key risk areas and seeing what sort of issues may be lurking in the actual everyday scenario. And a lot of times these things don't come out as part of the due diligence effectively, at least not in my experience. And it takes somebody with real practical knowledge of trade compliance regulations, of trade compliance practices, to be able to identify them. And typically those only get identified with actual transactions, with actual information in your hand. In order to help you get there, I have 4 different things that I just kind of repeat over and over again. I gather facts. I document what I'm finding. I address any concerns, either by acknowledging that they exist or evaluating whether or not they are real, or basically digging in deeper, or even just putting them on the back burner if it's not a big enough deal. And then I align efforts to address those issues. And then I repeat that over and over and over again with each of the compliance risk zones, with each of the operations that are ongoing in the business. And I think it's important to recognize that for trade compliance in the M&A universe, there are 2 critical things that have to be established out the gate. One is you really, really want to have a seat at the table where the discussions about the transition are happening. You want to be in the room so that you have a chance to understand what's supposed to happen, so that you can observe whether or not that is what's actually taking place. And if you can't be in that room, if you can't have a seat at that table, then make sure you've got access to someone who is, and that person is actually an advocate and understands what trade compliance is, and understands what the cascading effect of improper trade compliance can have on an organization. If you have your exports suspended, that's going to have a major impact on your global sales. There are a lot of ways that imported product can be seized if they're not in compliance with regulations, or have to be re-exported or destroyed, and that's going to have an impact on your production. Knowing the severity of trade compliance and how it affects ongoing operations is important. So if you have a seat at that table where those discussions are happening, you can get ahead of, or at least help navigate through, the challenges that arise. So that's one thing, is having a seat at the table, whether it's you personally or it's somebody else that can be an advocate for trade compliance that understands what trade compliance is. In my experience, most trade compliance folks don't find out until the 12th hour that these things are happening, but let's leave that alone for now. The second thing that I think is very, very important is to make sure that you have the authority to stop shipments that are non-compliant, and make sure that the rest of the transition teams are aware that you have that authority. You want to use words like, I will not allow regulatory violations to occur. You need to be strong enough to say to a board of directors, to a CEO, that you are going to be standing in the way of the company violating the law. Inform them that customs can and will seize materials coming in and our products going out if these things are not rectified. Ensure that you are raising the red flags properly when you do uncover significant concerns. Significant concerns is a subjective term. I recognize that. But obviously, if you find something that is a substantial violation of the law, somebody has to have the authority to stop those things. And If it's not you personally, then you need to make sure that there is somebody that is going to do that and has that responsibility, has that authority, and can take action to prevent the company from violating regulations, which could jeopardize the entire business's operations going forward. You should be able to say things like, look, I'm sorry you don't understand how international trade works, but I do. And this is what needs to happen before we go forward, or words to that effect. I've not had a chance to use those words, and I don't intend to, but sometimes I think them in my head. So some of the cornerstone information that should be established out the gate when evaluating M&A is understanding the trade landscape and the shape of the international transactions that are being affected. In some M&A scenarios, both companies will kind of continue on unchanged for some period of time. Maybe it's part of a transition services agreement. Maybe it's part of a perpetual operating independence. That could be the case. But what you need to understand, if you are responsible for trade compliance, is who the entities are in the transactions, particularly the importers of record, the IORs, and the United States Principal Parties in Interest, USPPIs. Know who the IOR is for your import side and who the USPPI is for the export side. You also want to know if your export transactions are routed or non-routed. That's going to inform how you prioritize and how you approach your export transactions. But you need to be extremely clear on who the operating either federal employee identification numbers or tax IDs or IRR numbers or NRI numbers. You need to know what entities are involved in this M&A scenario. If you are acquiring a Canadian business that is operating as an NRI in the US and nobody's paying attention to that, as a trade compliance professional, you're going to have to be on top of that and know how those transactions are going to be affected by the acquisition. You're also going to want to be able to file or confirm the customs registrations on file with CBP. That's CBP form 5106. You can do that via your customs broker. They can look it up for you and tell you what customs has on file. If you're creating new entities or you're changing names or if you're changing HQ addresses, those sorts of things are relevant to customs, and they will hold imports pending confirmation of certain factors. It's not uncommon for brokers to refuse to file an entry without documentation supporting the stance that you're taking. I'll get to that in a moment, but you want to make sure that you've got very clear information on file with customs and that those pieces are in alignment with your understanding. You also want to evaluate the bond sufficiency. You want to evaluate your bond sufficiency by running a bond query and comparing it against import data, particularly data that integrates that new surface area of the merger and acquisition. If your bond was for $50,000 and you're increasing your imports by tenfold, that $50,000 bond may no longer be sufficient and you'll need to increase the size of it. Running a bond sufficiency test or bond query to understand where things are will help you create that scenario. Customs has the right to request and demand payment prior to release of the goods. So you may have to be paying a lot of money out of pocket in order to receive your goods if your bond is found to be insufficient. And all that can be checked well in advance of the acquisition taking place. The earlier you can identify those things, particularly if you need to create a new importer. If you're registering a new tax ID number and having to set up a new import bond, those things can take time. So you want to start them usually 60 to 90 days in advance of them needing to be in place to ensure that all parties have the time it takes to navigate through all of those different layers. You're securing new bonds. You don't want to be importing without a customs bond, a continuous customs bond in place, particularly in the early days of an M&A scenario, and also in a divestiture scenario. Recognizing your available resources. You want to be able to recognize and identify particularly internal resources. Anyone that played a role in the trade compliance activities and the international transactions prior to the M&A, you want to make sure that you know who they are and what information they have available to them. Confirm access to compliance data, particularly ACE reports if you can get them. Make sure that if you don't have access to ACE reports already, see if you can get them established prior to day one, depending on what the entities are. How you create those ACE reports is up for discussion, but you want to make sure that you have access to as much information as you can get. And if you can't get it from ACE, which is the automated commercial environment, we'll talk about that a little bit more as we go, then you'll have to rely on your supply chain partners, people like your customs brokers or your ERP systems. Use those tools and those data sources to paint the profile and the picture of what your activity, your international trade activity looks like. You also want to be able to map your supply chain. That includes identifying all of the active partners, your import brokers, your export filers, the freight forwarders, your 3PLs, international carriers, any other agents or intermediaries that handle your cargo, whether it's coming in or out. You want to be able to identify who all those players are. In addition, you want to make sure that they're informed of the relevant changes early so that they can make adjustments on their end. You can't file an entry against an entity that doesn't exist yet, or against an entry that was just absolved and dissolved. If the entry no longer exists, the broker can't file an entry against it, and therefore they don't have a way to file an entry against an entity that they don't have power of attorney for, or the documentation is not in line. Then you're going to have a problem and goods will be held at the border. Best case scenario, you get just detention and demurrage charges that you have to pay. In worst case scenario, the goods get either re-exported or seized. You also may need to reissue, revoke, or otherwise adjust your powers of attorney and written authorizations, or how your customs duties and fees are paid. If you're currently paying them on periodic monthly statement, but that entity is going away, that periodic monthly statement or that bank account is going away during the M&A process, your duty payment is going to be affected, and you need to have a plan in place. So knowing what your supply chain looks like and how those things work together and who the players are in that equation is essential to that. You're also going to need to notify your suppliers and your customers. They're going to need to be informed of any key changes in the documents that you need them to make. And you want to be specific about which documents need to change and what those documents need to say going forward. If it's a business name change and nothing else is adjusted, make sure that they update that in all of the places where that name appears on their documents, their bills of lading, on their commercial invoices, on their pro forma invoices, on their packing lists, on their blah, blah, blah. Make sure that it's updated in all the right places, or it will create issues at the border. And you'll also want to have a map of your supply chain for any supply chain security programs that you participate in, particularly things like CTPAT or Authorized Economic Operator, AEO. And you want to notify your SCSS, your supply chain security specialist in CTPAT, if you are making changes to your entity structure, and you'll want to update your CTPAT portal accordingly. So having that information of what your supply chain is going to look like is essential to that. I also have a question here. Is an exporter of record equal to a US PPI? And that's a valid question. In fact, the importer of record is a term within the regulations, but the exporter of record is not a term in the regulations anymore. It used to be there up until like 2002, I want to say, but they changed the term exporter of record to principal parties in interest. And there are two principal parties in interest. There is the US principal party in interest and the foreign principal party in interest. And the regulations apply to them depending on the nature of the transaction, whether it's routed or non-routed. So yes, to answer your question, export of record is equal to US PPI, but export of record is no longer a term that is used. Moving on from that, I want to call attention to a common merger and acquisition trap. This is corporate compliance activity versus customs business. And this is one that I have not yet found an M&A consultant or lawyer who understands the difference. They are not trade attorneys typically. They are not familiar with customs regulations. And they don't recognize that in an M&A scenario, people who work for one of the companies have a limit on what types of business they're allowed to transact on behalf of that new entity. Customs business includes those activities concerning the entry and admissibility of merchandise, its classification and valuation and payment of duties, as well as any activities related to the preparation of documents to be filed with CBP, whether or not signed by the preparer. Only licensed brokers with a valid permit acting as LCBs within the district are permitted to transact customs business in the US. And a lot of times I will see specialists or analysts or desk level folks being assigned to classify a product or form the broker of what the value is, or do some other factor, submit post-entry amendment or post-summary corrections for changes to entries. When that desk level person is not a representative, does not work for that entity. And that's considered transacting customs business, which is on its face a violation. And you can use these customs rulings that go into much deeper detail. And when I say at the bottom here, the only licensed customs brokers, I don't mean human beings with a customs broker license. I mean corporations that are licensed as customs brokers and have a valid national permit under the new customs broker regulations. Having an employee who is a licensed customs broker does not allow you to do these things. They have to be acting as a customs broker in the context of what a licensed customs broker business is, and using their permit as an individual, not as part of that other business. So that can get a little confusing when I say licensed customs brokers, I mean the companies. I'm not going to dig too deeply into this right now. There are links to help you understand what the definitions of these things are, the definition of what customs business includes. And generally, just to give you a high level, customs business includes advice relating to the processes of classifying, but not providing actual classifications. You cannot sign things like FTA certifications. That would be considered customs business, but corporate compliance activity would allow you to teach people how to interpret the rules of origin on a free trade agreement. So we'll kind of leave that be for now. Okay, recognizing some of your information sources, and these are essential to success. If you do not have access to good information, then it's going to be almost impossible to quantify the risks and navigate through any challenges that may occur. And I find ACE reports to be an essential element of actually getting actual information about what is real. ACE reports are an excellent tool. They provide me information on what sort of special indicators are being claimed, special indicators including things like free trade agreements. How many brokers are actively filing entries on my behalf? What sort of countries of origin are we focusing on? What types of entry do we use? What country of export are we working with? What HS codes are most common? How much duty are we paying? All of these factors can be found through ACE reports, particularly the ES002 and the ES003 reports. Those are my two go-tos on the entry summary side. ES stands for entry summary. If you're not familiar with how ACE works, I don't have the space to go into it on this session, but we did just do an ACE webinar a couple weeks back, maybe a couple months, I don't know. And I highly recommend learning how ACE works and what you can do with it. It is a very powerful tool because it gives you access to information that both customs and census collect in relation to those EIN numbers, to those IOR numbers, to those US PPIs. It's actual data that customs and census have on file for you. You want to be able to see what they see. It really helps prioritize where your efforts go and recognize any outliers. However, ACE reports have their limits, and I like to understand transactions at a much deeper level by going to the actual transaction data themselves. I prefer to use things like entry packets from the brokers, as well as, or in conjunction with, reports run out of ERP systems and smash the data together to get a picture of what's being brought in, what is being used for while it's here, what's being shipped out, and starting to paint that picture. And using actual documentation helps me understand if there's any discrepancies between what was claimed and what actually happened. A lot of times those discrepancies are gaps in understanding. They're not actual problems. It's just that, oh yeah, this supplier provides two invoices. The one that we use is this one for these reasons because this is what's supposed to be there. And then you can make sense of those scenarios and start to understand the actual transactions by leveraging real information. That information would never appear on an ACE report. You wouldn't know that the supplier provides two different invoices under different circumstances, and you wouldn't know which one was correct. And in fact, I use actual humans as an effective tool to bridge those gaps because by and large, humans are smarter than machines. I know it sounds probably counterintuitive to a lot of people, but the humans that work on this stuff every day, that actually live at their desks and have to process the paperwork and deal with the questions, those people have really good insight into what's actually happening, regardless of what the company's intentions are, regardless of what the salesperson thought they were doing or what the purchasing team thought they were doing. The people at the trade compliance desk, sometimes on the logistics side, those are the ones that know what is actually happening with trade compliance, with imports, with the exports. They're the ones that deal with the weird questions from the PGAs that the purchasing team never knows about. They're the ones that deal with the export licenses that the sales team never really knows how to navigate. You want to talk to actual humans and sit down in the room with them and spend time, sometimes multiple sessions, working with them to understand what it is they deal with on a day-to-day basis, because that will help bridge the gaps between the gaps in the ACE data and the transaction data when you recognize what the actual humans are doing every single day. And I cannot overstate how important actual humans are in the equation, with the caveat that don't just take what somebody says at face value, make sure that it's corroborated by the data that exists, because people have a lot of assumptions and data doesn't make assumptions. The three big risk zones that I think every trade compliance professional needs to eliminate as a concern first are customs value, HS classification, and country of origin. These are the three factors that any customs administration is going to focus on first and foremost, because it affects their ability to collect revenue. If your values are misdeclared, most countries have a VAT based on the value of the goods. And if your value is underdeclared, you're depriving them of sometimes 20-some% of taxes that are due on those imports. HS classification affects the duty rates, affects AD/CVD implications, affects a whole lot of other layers. The HTS-US is the legal basis for the application of tariffs and duty rates. It informs tariff-related programs, including things like free trade agreements, AD/CVD, sections 232 and 301, and quite a bit more. HS classification is a relevant factor for how much money the customs administrations collect on imports into their country. And lastly, country of origin, which also drives things like AD/CVD, section 301, section 232, and free trade agreements. These are all factors that influence how much money the government collects. And if you have problems here, these are the ones they're going to see first. And these are the ones you're going to want to fix first if there is an actual problem. And I'm saying generally, customs administrations pay attention to this. In the US, obviously on the import side, the import regulations have very clear valuation methods and how you can calculate and construct the value for your shipments. But on the export side, we tend to pay less attention to that as trade compliance professionals, because those export sales tend to not have the same sort of penalties associated with them against our business. They tend to be penalties associated with the customer's business. However, customs in that foreign country will happily assess penalties against your customer, and your customer is not going to be happy about it. So paying attention to customs value throughout your supply chain is important. One of the things about value that are often overlooked are things like related party transactions, particularly if you're merging with a previously unrelated customer or supplier. If you're expanding your vertical, you were once arm's length businesses and now you're related party transactions. The valuation methods that you use may need to change, and you need to establish a different rule for arriving at your customs value after that merger and acquisition occurs. Another thing that's overlooked for value are assists. A lot of companies have, we'll say, inadequate or incomplete documentation on how the assist universes are constructed and administered and maintained. A lot of times assist information just kind of lives in somebody's head. And it's one of the areas where it's so easy to not recognize that assists are part of the equation because somebody is keeping a spreadsheet on their desktop and none of those calculations are being brought forward. That person knows to notify the broker of what the adjusted value is, but nobody else does. So making sure that you ask those questions about assists and tooling and other issues like that. And similarly, things like first sale. If you're taking advantage of first sale, while this one tends to be much more documented than assists, it is still one of the factors that needs to be understood about customs value before proceeding with an M&A. And just knowing how you're going to address it, asking the question, getting the answer, what's real, standing up a process or writing it down, and then circling around to the next thing on the list. You just kind of repeat that pattern. Okay, there's a big list of things here. Now, what I wanted to do was give kind of everybody a one-stop shop. So when you get the slides, you'll have this list just that you can click back over to. And I'm going to try and review several of these just so you understand what I'm talking about. One of the top things that needs to be understood or looked at, aside from value, HS, and origin, you want to be able to capture and document current and future state practices across all risk zones. Here's more than 24 compliance risk zones that you should be paying attention to that you may not be. There are others that are not documented here, but they're more kind of edge case. Prior penalties, previous disclosures, and customs notifications. Bullets 1, 2, and 3 there. Basically, if there have been any dealings with a government agency regarding either an inquiry or a penalty on imported or exported goods, you need to have asked for and obtained the information, the documentation associated with those things, and understood what was claimed to those agencies previously. If it was a penalty scenario, those penalties will come with not only a monetary assessment, but also an instruction on preventing that violation from happening again in the future. And you need to understand what the circumstances are. If a disclosure was submitted to either customs or to BIS on an import or an export, you will have told those agencies what your corrective actions are that will help prevent these from happening in the future. Knowing what those claims were, what those statements are, is essential to avoiding penalty going forward by accident. If you told customs that you will evaluate every entry against your master list of HS classifications, and then you just stop doing it one day, they're not going to like that. If you told the BIS that you're going to ensure that every single item in your product catalog has an ECCN number assigned to it, and you don't maintain that post M&A, then they're going to have a problem with that. You also want to recognize the control technologies and licenses, as well as restricted party screening practices that are in place before, during, and after the M&A. Control technologies and licenses tend to be obtained outside of systems. They're either done by possibly a third party, possibly engineering teams, possibly sales teams. There's a lot of different players that can be involved in actually obtaining an export license for control technologies. You're going to have personnel as potential risks and foreign nationals. So you have to do a pretty good diligence on knowing what is controlled and for what reasons and what controls are in place regarding those. That's where restricted party screening practices come into play, particularly when you're integrating two different customer profiles and sets or supplier profiles between two different businesses. Knowing which ones are screened and what steps were taken to greenlight the customers that are currently in play or greenlight the personnel that are working at the shop currently, and applying that to the new entity is very important. There are a lot of different programs on here, and I guess I did get a little bit long-winded, so I am not going to be able to go through all of these like I had planned to. A couple of the ones that jump out at me as very important, or actually forced labor and free trade agreements, we have webinars on, as well as non-routed exports number 23 there, and Incoterms number 24. We have webinars on these things on our website. You can feel free to look at those. I talked a bit about broker and forwarder relationships. Powers of attorney and written authorizations may need to be reissued in the proper entities' names with the proper tax IDs. And you're also going to want to make sure that the empowered officials that were in place prior to the merger or acquisition either have been replaced post or continue to have the authority to act under the new entity that's been formed. Cross rulings is another good tactic for finding out information about the classification universe. Just typing in either the company's name or a couple of product numbers that you know have been around for a while. Cross rulings can give you tremendous insight into how classifications were decided long ago, especially if you are lacking good humans to talk to. Okay, I'll leave the rest for later. Public resources you can use to help you get organized. These first two here, CBP publishes their focus assessment program and the series of questions that they're going to subject businesses to as part of that program and what they've done in the past. You can just pull up that list and know what sort of questions CBP asks. I have found in the past that if you follow what customs plans to do, you're going to have pretty good coverage on what your risk zones are. CBP also publishes an informed compliance publication, an ICP, on reasonable care, which identifies several fundamental areas and methods for ensuring those areas are addressed adequately. It asks you a series of questions. You can just ask that new entity those questions and get some pretty useful answers. You'll still have to identify what to do about the answers that you get, but that's going to be unique to whatever those answers are. But I do find these resources that the Customs has put out very, very helpful, especially when tackling the import side and knowing what the agency themselves is pursuing. If I pursue those same things, I'm going to be on a pretty good footing, especially if I can produce the results of that evaluation. BIS also puts out red flag indicators and know your customer guidance. Pretty straightforward tools to help you evaluate and inform your teams of what sort of things to look for. You can use those red flag indicators and that customer guidance to basically develop a policy or a practice or an evaluation tool to examine whether or not your existing sales practices are accounting for these areas. They also have published the Export Compliance Program and Export Compliance Guidelines. Those two references there are tremendous resources for building out and evaluating what the export compliance practices are of the company that's being acquired or that you're merging with. And knowing how to establish protocols aligned with those is going to be a big leg up. And then lastly, we do what we call a trade compliance scorecard. We evaluate businesses, whether it's an M&A scenario or if it's just because. We evaluate across many trade compliance risk zones, assign them a score, identify corrective actions if we find any, and provide that to you, usually as a working tool for you to start to build out your program yourselves and move forward from there. If you're interested in something like that, you can reach out to us. We're going to tackle some questions here momentarily. One of the ones that came in previously is on the screen here, and I wanted to use this as a talking point. So the question is, when acquiring a new business, are we entitled to 5 years of entry documents from the broker? Kind of. The prior importer of record, the prior IOR, should and would supply all of the entry documentation relating to its import history. They'll be the first ones to ask. They're the ones being bought. They're the ones that should have the records. They're required under the record keeping obligations in 19 CFR to be able to have and be able to produce records, and producing them to the entity that's buying them is one of those things that they would be expected to do. However, not all companies keep records, and a lot of them rely on brokers, which is not correct. Do not rely on your brokers to keep your records, keep your own records. But if the broker is the one that keeps the records, then you want to make sure that you have the proper authorizations. The broker is not allowed to just disclose confidential business information without written authorization to do so. And if they have not been given that clearance to do that, then they're not under any real obligation to do so. So you want to make sure that you've covered that base. So yes, the broker can give you import documentation. Keep in mind that it's only going to be documentation that was given to the broker in connection with their performance of duties, and they are not required to retain documents that are not related to their services. So it will never be the entire picture, but it will be better than nothing. In most cases, I recommend getting docs from the importer and docs from the broker and docs from ACE and talking to people. But yes, 5 years is what is required by law to be kept, and that's what you should be able to get at least. We have a couple of other questions I'm going to tackle. One question here is, what impact does mergers and acquisitions have on regulatory changes? I don't know that I understand that question. Regulatory changes are going to have impacts on the compliance risk zones. Like, for example, Section 301 and Section 232 were not a thing that we needed to think about prior to 2018, but now they're a major factor. USMCA shifted the focus of what sort of things that we need to pay attention to when it comes to free trade agreements. When NAFTA went out the window, in the USMCA scenario, we no longer had to validate things like NAFTA Form 434s being of a particular type. So that was very useful. The question says, what impact does mergers and acquisitions have on regulatory changes? I think maybe if you're asking that in the broad sense, we've seen a rash of M&As across many industries lately. The international trade compliance industry for sure, but also manufacturing, also carriers, also freight forwarders, also just a lot of different industries have been undergoing a lot of M&A acquisition kind of in the post-COVID universe. And as entities get bigger, they do exercise more and more influence on regulatory bodies such as Congress, and they can affect laws. So I'm not sure exactly what the answer to your question is, other than M&A has impact on regulations, and the regulations have impacts on M&As. What is a good framework for deep diving into a new acquisition existing compliance program? Okay, so actually that stuff I was just talking about at the end relating to these tools, these 3 slides here. On the import side, paying attention to CBP's focused assessment program and reasonable care guidance. And these aren't particularly current, but they're still useful and relevant. They're not the whole picture. Using these as a starting point, using BIS's red flags and export compliance program guidance, and potentially working with a third party that knows what they're looking for and can help you find and suss out the areas of concern. Those are good frameworks. Start with any of those to build out basically a way to evaluate what compliance risks you have. Company acquired did not previously have a trade compliance team. What is the best way to integrate? Yeah, that's real common. When the 2 entities have unequal trade compliance teams, let's say, or imbalances on that, and usually by virtue of one of the businesses not having any trade compliance whatsoever, it's just being somebody's job by accident. It doesn't really change the approach. What you lose is good access to a human that knows what's going on. So you have to piece together the information. It's harder to piece together the information because you're relying on data sources, and data sources don't give you much context to work with. I encourage you to work with customs brokers that have been on account for a long time if they exist, or freight forwarders, or if possible, talk to a purchasing manager or a sales manager about the challenges that the suppliers have had when shipping goods or that the customers have had when receiving goods. Is start to get that context built up. If you don't have somebody that you can work with that actually tackled those things, also be prepared for there to be a lot of discrepancies and issues and potential violations. Maybe not to a significant degree, depending on the size of the company. If they don't have trade compliance, they're hopefully not too big, but be prepared to make disclosures because there's a very good chance that they don't have the controls in place to actually prevent issues from happening. And the last thing you want to do is have a big penalty on top of the cost of an acquisition. Okay, next question. If an acquired company is located in Europe and never had any compliance program, company that acquired it is a US company, what's the time frame for the acquired company to adopt a compliance program, and is the owner responsible for not having a program in the past? It's similar to the one I was just talking about, but a little bit different with the different countries involved. So the buying company is a US company, they're buying a European company. What's the time frame for the acquired company to adopt a compliance program? So there's no specific time frame for the acquired company to adopt a compliance program in terms of the regulations. In terms of successful business integrations, I generally allow for 6 months to transition new services and get new processes stood up. You're going to need cross-functional teams to be aware of what the changes are. You're going to have diligence done by internal and external parties. I don't know if that's 6 months from the date of the transition, like day one, or if it's 6 months from the announcement of the merger or the acquisition, which is usually 9 days or more before day one. But it usually takes about 6 months on the calendar to align the teams for the new state. And then it's going to be another X amount of months to actually succeed at those things. A lot of times success isn't even ever full until ERP systems are integrated. So it can take a significant amount of other hurdles to be overcome before both the European purchased company and the US acquiring company are operating on the same wavelength. One of the things to be cautious about, again, when dealing with foreign companies are things like controlled technologies. Now, the US and EU definitely have a lot of things where licenses may or may not be required, but you need to be aware of the nationalities of the people working in those locations and what degree of information they have access to. And is the owner responsible for not having a program in the past? A follow-up question to that same one. Is the owner responsible for not having it? So there is no requirement that you have a program. The requirement states that you may not violate the requirements for importing and the requirements for exporting. So like on exports, you are only in violation if you sold controlled technologies to a person that was prohibited, or if you exported without a license. That's where the violation occurs. If you have no program in place, that's not a violation by itself. It's just one of the factors that they use when considering what degree of penalty to issue. The owner is not responsible for not having a program in the past, but the owner is going to be responsible for any violations that occurred in the past. I'm not 100% sure how successor liability works across continents and across country lines, but presumably the EU would penalize the entity that still exists in the EU, which would then be borne by the US company that owns them. So yeah, the new owner would be likely liable for any violations that occurred in the past. You can't just wipe the slate clean by buying a company or selling. Okay, that was the last of the questions. Thank you for being here with us today. Please send any questions you have or check out our website for additional materials. Have a nice day.